What's up, everybody? This is Sunko, the Korean bro. Today is 2023, uh, June, July, August, September 4th. Okay, let's see, okay? Hmm. You don't have to pick a winner in fintech. Here's why. Okay. Salesforce stock is top buy in a new era for the cloud. Shroom stock, bear versus bull. Three key things from Lululemon's earnings call that investors should know. CrowdStrike boosts its profitable growth outlook. Time to buy this cybersecurity leader. Hmm. Hmm. Okay. Let's see. Let's start. You don't have to pick a winner in fintech. Here's why. Payments business can be fertile haunting ground for solid investment ideas. There's no shortage of companies focused on singular areas within financial services. The war on cash. The Shea service provider, SoFi Technologies, Lemonade. Hmm. Financial services is an ancient industry, and in recent decades, it's often lagged behind others when it comes to improving the user experience. But this has been changing. One of the most notable trends this century has been the growing popularity of fintech or financial technology. Using the connected power of the internet, fintech businesses have made traditional financial products simpler and more accessible to customers, winning monumental growth for themselves. This makes it an attractive place to look for investing opportunities. There are lots of different fintech enterprises out there serving different needs, so investors don't need to pick a single fintech winner. Instead, they can allocate their capital to multiple different businesses in the space. Let's take a closer look. There are other payments companies to pay attention to, having been founded more than 2 decades ago. PayPal was a digital payments pioneer, providing consumers with services that make it easy to pay for things online and send money to friends, letting merchants more seamlessly accept online payments. The business has 431 million active accounts today and processed $1.4 trillion in total payment volume the last 12 months. Block has come a long way from its days selling the small accessory that turned a smartphone into a point of sale terminal. The company operates two budding payment ecosystems, Square and Cash App, which combined registered $1.9 billion of gross profit in the most recent quarter. On the merchant side, Square offers a vast array of hardware, software, and financial services products, and Cash App, now with 54 million monthly active users, is a popular personal finance tool that for some consumers can be a substitute to having a traditional bank account. Outside of payment, which has proven to be a very lucrative industry, investors should know about more specialized fintech companies that offer unique services. SoFi Technologies is a digital banking provider that offers numerous services like checking and savings accounts, credit cards, and student loans. Geared toward a younger, affluent demographic, the online bank deposit base continues to grow with each passing quarter. Its management team believes it can achieve positive net income in the fourth quarter of this year. Okay. Salesforce starts top line a new era for the cloud. Salesforce, but expectations in its last quarter and again raised full year guidance. The company looks well positioned. Whether it's slow down in the economy, the enterprise software provider is executing well, and profit margins are increasing. Salesforce is back to its old days of under promising and over delivering, but it with a twist. Salesforce was one of the pioneer of cloud based software. We fell out of favor during the pandemic as expenses soared and revenue growth suddenly slowed. It was all but forgotten except by longtime shareholders that co-founders and longtime CEO Mark Benioff actually knows how to grow a profitable business. Benioff and company just provided a reminder that they know what they're doing. The company beat expectations in its latest quarter and provided yet another upgrade to its outlook for current year profitable growth. As the economy slows and what consumers need from cloud-based software evolves, Salesforce remains a top-notch stock in my book. Solid execution in slowing economy. Top cloud software stock. Solid execution and slowing economy. Of course, Salesforce predicted 11% pace of revenue growth is a sharp slowdown from its pacing of over 20% in years past. You can't choke this up to tradition year for Salesforce, but a slowing global economy is also blind. Organizations are still in cash conservation mode and are delaying new software deployments for now. However, as Benioff explained in the last couple of quarters, Salesforce is revamping its large software set to provide more of what consumers need: automation. One way cloud users are looking to cut costs is by finding new ways to automate tasks, which reduces the need to hire new employees or otherwise allows them to shift their workforce away from redundant tasks to focus on other things. In the current round, the automation is coming in the form of generative AI, embodied by OpenAI ChatGPT. Salesforce has already embedded generative AI throughout many of its services, from the core relationship management software to its data analytics platform Tableau, and continues to advance new ways to make its software more predictive and insightful. These updates do come with some product price increases, but Salesforce recently signed its pricing changes already first in 7 years. Generative AI is just the latest product improvement that's been released in that time. It's too early to say what's in store for Salesforce next year, but I expect growth from these new initiatives to kick in, adding more expected profit margin increases. And it's not hard to see why the market has quickly warmed up to the stock again this year. Following the quarterly update, Salesforce traded 465 times expected current year earnings per share. Hmm. Zoom is expanding its enterprise business and remains profitable. However, the bears believe its best days of growth are behind it. Competition is growing in the video communication space. Um, in the constant Wall Street battle between pessimists and optimists, the bears have the upper hand of Zoom video communication stock today. The software company share have dropped over 70% since 2021, when its platform was the number one choice for millions of people conducting meetings during pandemic fueled social restrictions. The stock is underperforming through the market rally this year as well. Yet Zoom's business is still setting sales records, even if growth is occurring at a much slower pace these days. Its financial position is strong with the bottom line and cash flow both positive through mid 2023. Let's take a look at what those encouraging factors puncture a hole in the bearish the thesis for the formerly high flying growth stock. The bearish outlook. Zoom is targeting nearly $5 billion of annual sales this year, which is many multiples of its pre-pandemic total of $700 million. Bears believe those high growth days are long gone, given that revenue will barely rise in 2023. Most Wall Street pros are projecting just 4% gains next year, too. Look closer though, and you will see compelling bright spots in Zoom's latest results. Its enterprise segment is expanding at a 10% rate right now. For example, and is attracting more large clients each quarter. Enterprise segment is expanding at a 10% rate right now. For example, and is attracting more large clients each quarter. Management believes this segment will be a huge source of momentum Going forward, through the combination of an increasing customer base and higher average spending, both factors are already lifting sales today. Incorporating artificial intelligence throughout the platform should also enhance productivity and also allow for higher contract sizes over time. Action Financial Shape operating cash flow was up 31% last quarter. Operating profitability set at 16% of sales, and Zoom held $6 billion of cash as of late July. These resources plus its established brand give the company valuable flexibility to attack different growth avenues over the coming years. CrowdStrike boosts its profitable growth outlook, timed by the cybersecurity leader. CrowdStrike has continued to grow at a fast pace even as the economy has slowed this year. The company has been able to balance growth with healthy increase in operating profit. This has the makings of being a great long-term holdings as cybersecurity needs are only expected to rise. CrowdStrike has emerged as one of just a few leaders as software security needs shift to AI. Shares of the endpoint security platform CrowdStrike Holdings uh, have been in rally mode in 2023, and for good reason, as the company just demonstrated during second quarter fiscal 2024, is still growing fast and notching increases in profitability. That's exactly what investors are looking for these days in the wake of the pandemic and slowing economic growth. But there are other factors to consider for CrowdStrike as artificial intelligence and consolidation of software vendors become top priorities in the business world. For now, CrowdStrike is finding plenty of places to invest in its cybersecurity platform. Generative AI is all the rage right now. And the new chip power system security analyst Chatload AI was recently demonstrated by the company. But this latest AI breakthrough is part of a broader dialogue around the need for a holistic cybersecurity platform that doesn't leave any gaps in an organization's security, as well as getting more done with less. CEO George Koch said on the last earnings call, organizations need better, faster, and more cost-effective protection for digital society. Organizations need seamless, not stitched together automation to break down legacy data silos. Organizations need lower and more efficient ROI-driven investment. The competitive battlefield of cybersecurity today reflects these realities, separating the wheat from the chaff. Those who have platforms versus those with point products in masquerading as platform stories. What was a market littered with dozens of companies is quickly consolidating into several vendors. Smaller, narrow point product companies are being left behind. CrowdStrike's Falcon platform with various types of AI powered automation woven throughout all the different modules is ready to deliver. The revenue growth uh, our performance relative to other cybersecurity peers, in spite of CrowdStrike's now quite large size, is proof that customers are seeing the value and choosing to spend more on the various and expanding Falcon security modules from endpoint to user identity protection. It all adds up to a best-in-class cybersecurity company and a top cybersecurity stock. To move progression profitability is needed because said and the top team have demonstrated their ability to balance growth with profit margin expansion. Shares currently trade for about 42 times trailing 12-month free cash flow. Uh, it's a premium price tag, so there will be plenty of bumps in the road for this stock as a result. But for investors looking at cybersecurity as a secular growth trend for the next decade, CrowdStrike still looks like a dollar coaching average and candidate to me here. The company already uses AI to prevent fraud. In 2017, it acquired Breton technology company that won Business Intelligence Group's uh, Artificial Intelligence Excellence Award in both 2022 and 2023. I look for MasterCard's operational efficiency to increase dramatically thanks to AI. Finally, MasterCard has already proven they can turn $100,000 into $1 million over a 20-year period. Actually, over the last 2 decades, the stock would have increased initial $100,000 investment to more than $9 million. I don't expect a kind of return over the next 20 years, but MasterCard doesn't have to reach that level to achieve our stated goal. Okay, let's look at this Datadog thingy, okay? Okay, Datadog helps users collect and make sense of observability and security data from across your IT environments. Its platform features more than a dozen products targeting different aspects of the corporate technology stack, but they collectively help clients keep their crucial applications and infrastructure performing. Its software also leans on AI to accelerate incident remediation, and it does so to great effect. Forrest Research recently recognized Datadog is a leader in AI software for IT operations. Datadog has innovated rapidly in recent years. It became the first platform to unify the three pillars of observability. In 2018, providing clients with unmatched visibility across their application infrastructure, and the company has branched into new observability and cybersecurity verticals every year since. Better yet, Datadog is a recognized market leader in several of those verticals, including application performance monitoring, log monitoring, and network monitoring. Performance monitoring, load monitoring, network monitoring. The adult earned $1.9 billion in revenue over the trailing 12 months, up 39% from the prior year. The management values its addressable market at $62 billion by 2026. Given its track record, it should come as no surprise. Datadog recently announced two innovations meant to capitalize on the growing demand for generative AI. LLM Observability is a performance monitoring product that helps businesses optimize their generative AI application, and BETS is a generative AI system that helps development and operations teams investigate and remediate issues more quickly. The bottom line, Datadog is littered in several observability software verticals. The demand for its software should rise as technologies like generative AI make corporate IT environments more complex. In fact, Wolf, a research analyst, Alice Zukin, thinks interest in generative AI could make Datadog fastest growing software company. This means in its current valuation of 16.2 times sales could look cheap and hence that and starting at bargain compared to the 3-year average of 35.6. Investors should feel comfortable buying a few shares of this growth stock today. Okay, let's look at this one. Time is trust added when you're investing in a innovative business with sustained competitive advantages. Okay, favor. Second, winning stock they can help deliver life-changing returns by 2043 is online services company Fiverr International. Fiverr has a mix of macro and complex fiscalis. They make it a no-brainer stock to own. To start with, the COVID-19 pandemic has completely changed the labor landscape. Though some people have returned to the office, more folks than ever are working remotely. That's actually news for a company like Fiverr. The platform connects freelancers with businesses looking for their services. Another catalyst for Fiverr is company's online service platform. Whereas most freelancer marketplaces provides service listings on an hourly basis, freelancers on Fiverr are listing their tasks as completed jobs. Choosing this route means the freelancer pricing is highly transparent, which is something that buyers really seem to appreciate, as evidenced by the persistent rise in the spend per buyer. Perhaps most importantly, Fiverr's take rate is unmatched among freelancer marketplaces. The take rate refers to the percentage of each negotiated deal Fiverr gets kept, including fees. Not only has the Fiverr's take rate continued to climb over the years, but its 30.7 take rate in the June ended quarter is nearly double that of its closest peers. Fiverr is taking a bigger cut and not chasing away freelancers or buyers. That's a winning formula. Taking a bigger cut, not chasing away freelancer or buyers. Oh, let's look at PayPal. The fifth and final surefire stock that can build generative wealth in 20 years is the fintech company PayPal Holdings. For starters who are still early in the growth cycle for digital payments, report released in May by Motion Consulting grew costs for global fintech sales grew roughly sixfold, from a $245 billion to $1.5 trillion by 2030. PayPal is a leader in the fintech industry and would therefore be in the driver's seat to benefit from this growth, despite historically high inflation in the US threatening to reduce discretionary spending for low earnings workers. PayPal's key performance indicators remain surprisingly strong. Total payment volume in its network continues to grow by a double-digit percentage. Size currency movement and active account engagement has soared since the pandemic began. Between the end of 2020 and June 30, 2023, the average number of transactions completed over the trailing 12-month period by active accounts has jumped 34% to 54.7. With PayPal being a free-driven business, increasing engagement is incredibly important. PayPal's management team is also doing what it can to reward long-term shareholders. The company expects to have reduced its 2023 operating expenses by at least $1.3 billion. It's targeting around $5 billion in share repurchases this year. Reduced share count should positively impact earnings per share for a company that's already historically cheap. Okay, it's getting really late tonight, so let's finish this and hope you have a good night and see you and bye bye. Bye bye.